So today we are going to be looking at CVP analysis. So what do you understand by CVP? The CVP represents the application of marginal costing technique to establish the relationship that exists between cost, volume, and profits at different activity level. CVP, also known as break-even analysis, represents the points where total revenue equates total cost. That is, the points where there is no gain or profits, in the sense that at any point above the break-even point, there will be profits. Then, at any point that the output is below the break-even point, there will be loss. Okay. Break-even analysis relies heavily on the behavioral classification of cost. That is, a cost item must be capable of being classified as either variable or fixed cost. All right. That's the introduction on the CVP analysis. What do you understand by contribution margin? Let's talk about contribution margin. Contribution margin represents the difference between sales value and variable cost, total variable cost, or the difference between selling price and variable cost per unit, or the summation of profits and fixed cost. That is contribution margin. I take it again. Contribution margin represents the difference between total revenue and total variable cost. It can also be defined as the difference between selling price and variable cost per unit, or the summation of fixed costs and profits. That is contribution margin. Therefore, how do you compute contribution margin? From the definition I just gave to you, you can say, depending on the information available, contribution can be calculated as total sales minus total variable cost. Okay. This pen has stopped working again. What's your problem? Why are you hanging? Anyway, I will use my mouse. What's happening? Location used by is longer place. Is it Latif that is causing this? I don't understand. Latif.
Yeah, God, sir.
I don't understand. Why is it me that? Why is it now that the pen is hanging? It's not even working. I even want to erase this one now. It's not working. It's hanging. In any case, let's move on. Let me see whatever I can do with my before I restart again. So, depending on the information available, contribution can be calculated as total costs minus total sales minus total variable cost. That is one. If in the question you are given selling price and variable cost per unit, then contribution per unit is selling price minus variable cost per unit. It is also possible in the question, if you are not given sales or you are not given selling price and you want to determine contribution, it is, of course, examiner can give you fixed cost and profits. If that happens, then contribution will then be the summation, the addition of fixed costs, and then the profits. So that will give you contribution you are looking for. So let's talk about contribution margin ratio. The contribution margin ratio, also known as profit volume ratio, represents the ratio of contributions to sales. All right. Contribution margin ratio represents the ratio of contribution to sales, and it can be calculated using any of the following formulas, depending on the information available. If in the question you are not given selling price, You also don't have profit or fixed cost. But you can see you have total sales. You are given total sales. You're also given total variable cost. Okay, and in the question you can see you also have contribution. Just divide contribution with the total sales. That will give you contribution margin ratio. But if in the question you are given selling price, you're also given variable cost per unit, then contribution margin ratio represents the difference between selling price and variable cost divided by the selling price. So that will give you the contribution margin ratio. The next one, if you are given total sales, you're also given total variable cost, and you want to calculate contribution margin ratio. So simply find the difference between total sales and total variable cost, and you divide it by the total sales. That will give you the contribution margin ratio. If you don't have sales value, but you are given fixed cost and then profits, the addition of fixed cost plus and profits divided by the, of course, you are given total sales, but you don't have variable cost. All right, you don't have variable cost. Therefore, fixed cost plus profit divided by sales will give you the contribution margin ratio. So whichever way, the information available will depend on the formula you are going to use will depend on the information available on that day. All right. So that's why you have to memorize all the relevant formulas. However, the question comes, you'll be able to tackle it. Now, before we move to objective of CVP analysis, let's talk about margin of safety. Okay, let's talk about margin of safety. Margin of safety represents the degree of change in output before a company will begin to incur loss. That is, margin of safety represents the extent to which output can fall before a company will start incurring loss. All right. What if the output fall by a specific percentage? All right. Okay. So just like if you want to determine sensitivity analysis, so margin of safety is similar to sensitivity analysis in risk and uncertainty. Now, margin of safety can be computed as the difference between the budgeted sales and the break-even point of sales. Okay, or when you say budgeted sales and the break-even point of sales, which means that it could be in units or in value. If it is in units, then of course you pick the budgeted sales units, you less break-even points of sales in units. The difference will give you the margin of safety. That will be the extent to which your output can fall before the company will begin to incur loss. Again, if it's as per, if margin of safety that you want to compute is as per cost, value, then the budgeted sales value minus break-even points in Naira. Okay, break-even points in Naira. So that will give you the margin of safety. You may want to determine the margin of safety in form of a percentage. Okay, you may want to determine the margin of safety in form of percentage. So depending on the information available, margin of safety in percentage will be budgeted sales minus break-even point of sales over budgeted sales. So that will be the extent to which your output can fall before the company will begin to incur loss. So that is how to calculate margin of safety. Is it back? Oh, not back yet. Oh, wow, this thing just want to mess my class today. Okay, let's move on. Now, let's talk about objective of CVP. There are 4 key objectives of cost volume profits analysis. CVP is very practical. Break-even analysis is very practical. For example, if a company is seeking funds for a particular purpose, that money is not readily available, the best would be to approach investors or your bank or your lenders to say, please, I need so much money. Depending on the size of the capital required, one of the documents that your prospective investors or your bank will request is the feasibility study report or the business plan. One of the sections of your business plans will include the short-term financial summary. It could be 1 year financial summary, 3 years financial summary, or 5 years financial summary. All right. So because your prospective investor or your lender wants to see whether how you are going to run the business profitably. Therefore, from your revenue to from the top line to the bottom line, from your revenue to your profits. So your prospective investor wants to see how you are going to be able, your sources of revenue, the likely expenses that you are going to incur, and how you are going to pay back, how you are going to pay the interest on the loan that you want to borrow. Okay, and then they want to see that you are going to run this business profitably. So that is financial summary. Another section of your business plan will include, you need to insert the break-even analysis. Okay, the break-even analysis of your project or of your investment. You need to demonstrate the worst case scenario. The worst case will be that you don't want to make profits. What if you don't make profits? All right. So the worst case will be that you are going to make, you don't want to incur loss, but just want to break even. So if you want to break even, and then you need to insert that in your business plan. And that's what I'm saying, that CVP analysis is a very practical, whether it's for manufacturing organization or service company. So irrespective, you can calculate break-even analysis for anyone, for any organization. Therefore, there are 4 key objectives that a company might want to, that CVP analysis wants to achieve. One is to determine the number of units required, okay, the number of units required to break even. Remember, when you break even, it means that there will be no profits, no gain. Sorry, no gain, no loss. No profit, no loss. That is break even, 0. I don't know why this thing is doing like, you need to communicate, and I don't want to restart again. Slowing my work. Let me see. I can't be using mouse. Okay. Yes. Let me just use mouse. That is for the first objective, to determine the number of units required to break even. Then 2, the second objective is to ascertain the sales value required to break even. Yes, you want to know. You don't want to make profit. You also don't want to incur loss. Therefore, how much sales are you going to make in the market for you to be able to break even? That's another objective, all right, of a CVP. The third one, this third one and the fourth one, you want to make profits. Therefore, what is the number of units? The objective is to determine the number of units required to achieve a targeted profit. In this case, you now have a targeted profit. You have a predetermined or intended profit that you want to earn. Therefore, how many units are we going to produce for us to be able to achieve the targeted profit? This will serve as a kind of a motivation to the organization. Say, for example, maybe you are just starting a business as a startup, all right? Then you now want to, in the first year, you want to achieve a profit of 100 million naira, for example, profit of 100 million naira. So that profit of 100 million naira is your predetermined profit. That's your targeted profit. Therefore, how many units are you going to produce for you to be able to achieve that your targeted profit? That is one objective of CVP. The fourth one is to determine the sales value required to achieve a predetermined profit. Okay, to achieve a predetermined profit. So how much sales are we going to make in the market for us to be able to make so much profit, or to achieve or to earn a targeted profit? That is the fourth objective of a CVP. All right. So each of these objectives has its own formulas that you are going to use, but I'm going to give you all relevant formulas once and for all. Please, at this point, because I don't know, let me just see what I can do, because this pen is really frustrating me. I don't like it. I can't communicate properly. It's not connecting at all. Okay, let's go to relevant formulas for calculating CVP, for calculating break-even. All right. Let me go down there. Okay. Yeah, these are the formulas. The first objective that states that to determine the units required to break even. In this case, when you want to calculate break-even points to achieve, break-even points to determine the number of units to break even. The formula is fixed cost divided by contribution. I'm not using pen, I'm using mouse. Fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. It's not just contribution, it's contribution per unit. Fixed cost, we manage it this evening, over contribution. This one is slowing down per unit. Okay, so that's the formula that you're going to use to calculate the break-even points in units. The second one is to determine the sales value, the sales value required to break even. If you want to calculate the sales value required to break even, then break-even point in Naira is equal to fixed cost divided by contribution margin ratio. Okay, fixed cost divided by contribution margin ratio. You need to first of all go ahead and compute your contribution margin ratio before you can calculate your break-even point in Naira. Then number three objective is to determine the units required to achieve a targeted profit. So in this case, the formula to use would then be, of course, break-even point in Naira will be equal to fixed cost plus targeted profit before tax over contribution per unit. Okay? All right? So like I said, if you want to calculate break-even points in unit to achieve a targeted profit before tax, then it is fixed cost plus targeted profits before tax. See the way I'm struggling. Targeted profit before tax over contribution per unit. Okay, that's the formula that you are going to use. Come, let me even ask you. Okay, maybe later. I will ask you later, but for now, let's move on. Okay, so that's the formula to use to calculate your break-even points in unit to achieve a targeted profit before tax. Then number four objective is to determine the sales value required to earn a desired profit before tax. To earn a desired profit before tax. All right. So in this case, the formula would then be break-even point in Naira equal to fixed cost. Fixed cost. My hand's supposed to be working too. Supposed to be this finger. It's not working. This one is slow. Fixed costs plus targeted profits before tax divided by contribution margin ratio. That's the formula to use whenever you want to calculate sales value required to achieve a targeted profit before tax. Please, the profit to use, the targeted profits must be profit before tax. Therefore, if profit after tax is given, it should be converted to profit before tax before calculating, when calculating break-even points. Okay, I repeat, the targeted profits to use must be profit before tax. So if profit after tax is given, you need to convert it to profit before tax before computing your break-even points. In this case, you may want to, examiner may tell you to calculate break-even points in units to achieve a targeted profit, after tax. All right. So you are going to convert that profit after tax to profit before tax. To do that, you are going to pick the fixed cost plus the targeted profit after tax divided by 1 minus tax rate, then over contribution per unit. So fixed cost plus targeted profits after tax that is given to you divided by 1 minus tax rates. Look at how my handwriting is ugly. Over contribution per unit. Okay. So that's the formula that you're going to use to compute your break-even points to achieve a targeted break-even point you need to achieve a targeted profit after tax. If you are given a profit after tax, this is the formula that you are going to use to convert it to profit before tax. Then the last one, examiner can ask you to calculate sales value required to achieve a targeted profit before tax. In this case, you are given profit after tax, so you also convert it to profits before tax. So to do this, the fixed cost plus targeted profits after tax given to you divided by 1 minus tax rates, then all divided by contribution margin ratio. That is the formula that you are going to use to compute the break-even point in Naira, where profit after tax is given. So these are the six relevant formulas that you can use to compute break-even points, okay? Break-even points. So yes, let me see before we move to multi-product break-even. So please, you need to read about the assumptions, the underlying assumptions of CVP analysis, the areas of application of CVP analysis, and then the limitation of CVP analysis. I will advise you to form a note. Write this in your notes. Write it down with your own hand so that the thing can sink, can sit down in your memory. Because as you are writing with your own hand, the thing will be there. Okay. All right then. So let's talk about multi-product break-even before we begin calculation. Multi-product break-even. The calculation of break-even points for a multi-product organization, that is company that produce more than one product, is different from the way the break-even point of a single product organization is computed. This is because different products will have different selling price, different variable cost, and different contribution. Okay, and different contribution. So as a result, the following procedures can then be used to compose break-even points for any company that produces more than one product. Step one is to compute. There are by 5 procedures. The step one is to compute the overall contribution margin ratio. This contribution margin ratio does not relate to any of the products. So it's the contribution margin ratio for the entire organization. Therefore, you divide the contribution of the entire organization with the total sales of the company as a whole. That will give you the contribution margin ratio. Then step 2, you compute the overall break-even point in Naira. That is the break-even point for the company as a whole. This is not the break-even point in Naira for any of the products, but for the company as a whole. So then, to get the break-even point in Naira for the company as a whole, just divide the fixed cost with the contribution margin ratio. Fixed cost divided by contribution margin ratio will give you the overall break-even point in Naira for the organization. Then step 3, you calculate 6 mix. You calculate 6 mix. 6 mix represents the sales value of each product, the sales value of each product divided by the company's total sales value. Okay, let's say for example you have product A, product B, then you also have product C, and you are given sales value for product A to be 100, sales value of product B to be 150, sales value of product C to be 120, or for simplicity, let's say 250 for simplicity. So the total sales value will then be 500. Total will then be 500. We have to manage it like this today. This is total. I can't imagine how we experience this kind of a thing today. Okay, that's the total sales value. To now get the sales mix of product A, I would then say A equal to the sales value of A, which is 100, divided by the total sales value. Total sales value is 500. That will give me the sales mix. That's a 0.2. That will give me the sales mix of A. You do the same thing for B. 150 divided by 500. Whatever you have, you put it down. You do for C. 250 divided by 500. That will be 50%. So that's how you are going to get the sales mix, or profit to sales ratio. All right. Then step 4, you calculate break-even points in Naira for each product. Okay, calculate break-even points in Naira for each product. How do you do this? Just multiply the sales mix in step 3 of each product. You multiply with the break-even point in Naira you have in step 2. So that will give you the break-even point in Naira for each product. That is, you multiply step 2 with step 3. All right, for each product. Then step 5, you determine break-even point in units. To get the break-even point in units, you divide the break-even point in Naira for each product. You divide it with the selling price. Okay, you divide it with the selling price of each product. All right, so that will give you the break-even point in Naira. Of course, you can marry step 1 and step 4 and 5 in a table. You can match everything together in a table. Okay, so this is the format you are supposed to use whenever you want to calculate break-even points in units for a multi-product organization. This is the format. The numbers you have here, they are just hypothetical numbers. I'll just assume those numbers for explanation purpose. So my explanation, my assumption is that the sales mix of product A is 30%, B is 30%, C is 40%. That's 100%. You then pick the break-even point in Naira. The break-even point in Naira for the entire organization is 5,000. So to now get the break-even point in Naira for product A, you are going to multiply 30%, the sales mix of A, 30%, you multiply with the break-even point in Naira of 5,000. 30% of 5,000 will give us 1,500. You do the same thing for product B. 30% of B multiplied by 5,000 break-even points in Naira will give us 1,500. For product C, 40% multiplied by 5,000 Naira will give us 2,000. So that is how you are going to calculate your break-even point in Naira. Then to get the break-even point in units, you are going to divide the break-even point in Naira for each product. You divide it with the selling price. Therefore, 1,500 divided by 10 Naira will give us 150 units. 1,500 divided by 15 Naira will give us 100 units. 2,000 Naira divided by 8 Naira will give us 250 units. This is how to compute break-even points in units and also in value in Naira for each product for a multi-product organization. So that is that. So at this point, let's have illustration, and let me know if you have any question for me. So before we start, I will just let me restart my system again so that the pen can come up. But right now I don't like it. I'm struggling. I can't communicate properly because my pen is not connecting with the PC. I don't know what's happening. Okay. Are we still together?
Yes, sir.
Jacinta, Janet, Judith?
Yes,
okay.
sir. We are together, sir.
I just want to be sure. All right then. So quickly, let me just let me restart again, and then so that you can start illustration. I can't be explaining without using the pen. It will be difficult for me. So let me stop sharing. Just give me just about 2 minutes to restart. So let's have illustration. Please don't disappoint me again. Let's have illustration. We are going to have 2 illustrations for single products and then 3 illustrations for multi-product organization. So let's start small. Right, let's start with illustration number 3 to demonstrate that. Yes, Marina Industries sold 150,000 units of its product at 20 naira per unit. 20 naira per unit is the selling price. Variable costs are 15 naira per unit. That is manufacturing cost of 12 naira and selling expenses of 3 naira. Fixed costs are incurred uniformly throughout the year and amount to 972,000 naira. That is manufacturing cost of 600,000 and selling expenses of 372,000 naira. You are required to calculate A, the break-even point in units and naira, B, the number of units that must be sold to earn an income of 75,000 naira before income tax. Then C, the number of units that must be sold to earn an after-tax profit of 100,000 naira if the income tax rate is 40%. Then D, the number of units required to break even if variable costs increase by 5% and fixed costs increase by 2.5%. So you want to determine break-even points in units and in naira based on the information available. So I want to believe you have the question opened at your end. So I will stop sharing and move to the working notes. Okay, the name of this company is Marina Industry. Marina Industries Limited. Number A, examiner is asking you to determine break-even points in units and in naira. So A, Roman figure 1, break-even points in units. You then say break-even points in units is calculated as fixed cost divided by contribution per unit, which is equal to, according to the question, fixed cost is 972,000 naira. Then divided by contribution per unit. Examiner did not give us contribution per unit, but we have information to get that. Selling price is 20 naira per unit. Variable cost per unit is 15 naira. Therefore, 20 minus 15 will give us 5. So 972 divided by 5. What do you have? 972 divided by 5. Yes. Are you still with me?
194,400.
194,400.
194,400 units. So this represents the units that must be produced for the company to be able to break even. All right, that's the answer to that. Number A, high. Break even points in naira. Okay, so this will be break even points. The break even points in naira is calculated as fixed cost divided by contribution margin ratio. 972,000 divided by contribution margin ratio will be equal to contribution per unit of 5 naira divided by selling price of 20 naira. So that will give us 0.25. Am I correct? Is it 0.25 or 0.2? That should be
0.25.
0.25. That's 0.25. So what do you have here?
3,888,000.
888,000. That's the sales value that must be sold for the company to be able to break even. Alternatively, you can then say break even point in naira is equal to break even point in units multiplied by selling price. So you get the same answer. This is 194,400 units multiplied by selling price of 20 naira. So you have the same thing as 3,888,000. So that's that. So we are done with the first, with the A requirements. The next one, number B, the number of units that must be sold to earn an income of 75,000 naira before tax. Okay? You need to earn income tax of 75,000. Number B, units required to earn a profit before tax of 75,000. So in this case, break-even points in units will be computed as fixed cost plus targeted profits before tax divided by contribution per unit equal to 972,000 plus targeted profit of 75,000, all divided by 5 naira. So what do you have? Use your calculator, give me the final answer. 972 plus 75 divided by 5.
That is 209,400.
209,400 units. So this is the number of units that must be produced for the company to achieve a targeted profit before tax of 75,000. Next one, number C, the number of units that must be sold to earn an after-tax profit of 100,000 naira if income tax rate is 40%. So you want to earn after-tax profit of 100,000. So number C, units required to achieve or to earn a profit after tax of 100,000 naira. Okay, so this will be equal to break-even points in units equal to fixed cost plus targeted profit after tax over 1 minus tax rates, all of this divided by contribution per unit. So which is equal to, fixed cost is 972,000 plus targeted profit of 100,000 over 1 minus 0.40 divided by contribution per unit of 5 naira. This is then equal to 972,000 plus, what do you have? 100,000 divided by 0.6. That will give you is it 133 or 166?
166,667.
Divided by 5. Final answer, give it to me. Yes, final answer.
227,733.4.
227,733 units.
0.2. Okay.
No. So that's the break-even points in units to achieve a targeted profit after tax of 100,000. That's how to calculate it. Number D, the number of units required to break even if variable cost increased by 5% and fixed cost increased by 2.5%. So before you calculate your break-even points, you need to make an adjustment. So number D, units required to achieve units required to break even. Okay, units required to break even, or just a break even point in units. Okay, we started again. Okay, break even points in units if variable cost increases by 5% and fixed cost increases by 2.5%. So first thing first, you need to make an adjustment in those variables, because if your variable cost increases, if your variable cost changes, then of course your contribution per unit will also change. Therefore, I would then say break-even point in units equal to, of course, the same formula, fixed cost over contribution per unit. Fixed cost has changed. Therefore, I would then go and calculate my workings. Working number one, I want to determine revised variable cost. The revised variable cost, original variable cost is 15 naira. Original variable cost is 15 naira. We're now told that variable cost will increase by 5%, therefore multiply by 1.05. So the revised variable cost will then be equal to 15 point what? 15 point what? Yes?
15.75.
15.75. That's the revised variable cost. Again, I will do the same thing for
Hello,
fixed cost.
sir.
Yes? Talk to me.
Is it 15% for calculating here? Because I'm trying to put the 5%. Oh, sorry. Yeah, I've gotten it. So
Okay. Then revised fixed cost. The original fixed cost is equal to 972,000. You're now told that fixed cost will increase by 2.5%. That will be multiplied by 1.025. Therefore, fixed cost, the revised fixed cost is what?
Oh boy.
Yes? What do you have?
996, 300.
996, 300. So that's the revised fixed cost. So because the variable cost has changed to 15.75, then also our contribution per unit will also change. So revised contribution per unit. You know, contribution equal to selling price minus variable cost. Therefore, the selling price still remain as 20, but variable cost has increased to 15.75. Therefore, revised contribution per unit is equal to 4.25. That's that. So in this case, I will then come here. The revised fixed cost is now 996, 300 divided by 4.25. Give it to me. What do you have?
Whatever.
4.25.
234.
234,
234.
424.
424 units.
Okay.
That's it.
Correct.
That's end of the question. That's end of the question. So it's as simple as that. All right.
Scroll
So
up, sir. Up. Scroll down, rather.
okay. So let's move to another illustration.
Okay, sir. Okay.
All right. I will stop sharing this.
Hold on, please. Hold on.
Oh, okay.
So can you please move it forward a bit? Up. Okay, thank you, sir. Thank you. Hold on.
I
Just
should hold
copy
on.
number D. Yeah, just to copy number D.
Oh, okay.
Okay, yeah. Thank you, sir.
That reminds me, where is Alexa? The last class we had on Thursday, she did not attend. Same thing today. I need to reach out to her. Okay, so I will stop sharing. Then share the material. So let's have another illustration. Let's try illustration number 4. Different scenario. Illustration number 4. Somebody should help us read. Illustration number 4. Who will read for us? Yes. Who will help us to read?
All right, sir. Can I read?
Yes, Moses, go ahead.
The following information is extracted by financial analysts from the book of
Ojopagogo.
Ujopagogo.
Moses, are you still there?
Let me continue, sir.
Ojopagogo 1,000. We have contribution of 200,000. Then
Moses, take it again. Take it again.
all right. The following information
Take it again.
okay, sir. The following information is extracted by financial analysts from the book of Ojopagogo Industries Limited. Sales 1 million.
Okay.
Variable cost.
Leave this one. Assume
Okay.
all figures assumed to be correct.
Correct. All right. You are required to calculate 1, the profit volume ratio. 2, the break-even point. B1, a proposal has been made to increase fixed cost by 10,000. If sales and variable costs remain unchanged, compute the new break-even point. B2, the company is also considering another proposal for modernizing its existing plant. This will need additional fixed cost of 25,000 naira, with the expectation of saving the same amount in each of the direct materials, direct labor costs. If this proposal is undertaken, compute the profit volume ratio, the break-even point, and the profit of the company. C, the management accounting has an important role to play in decision making. Discuss this statement, explain the concept which may be relevant and enumerate type of decision to make. Okay, sorry. And enumerate types of decision to which they may be applied. End of the question.
Thank you. Yeah, thank you. The A requirement says that you should calculate profit volume ratio. So without wasting more time, let me stop sharing this. Go to the working notes. So, solution. Oh, this thing has started again. Oh, what's up this now? This is at least I've wasted about almost 15 minutes now because of pen not connecting with PC. What shall I do? Okay, stop sharing. So the question read by Moses is the Ojopagogo. Then in the requirement number A, you have to determine profit volume ratio. Profit volume ratio is the same thing as contribution margin ratio. So in this case, what are you supposed to do? The most important thing you need to do, you go into the question, you check if you are given selling price. In this question, we don't have selling price and we're also not given the number of units. Therefore, but we can see total sales value to be 1 million naira. Total variable cost to be 800,000. It means that contribution per unit, here is contribution margin. Contribution margin is 200,000. So since we have contribution margin, I would then say PVR is equal to contribution divided by sales, which is equal to 200,000 divided by 1 million naira. Therefore, contribution margin ratio of PVR is equal to 0.2 or 20%. 0.2 or 20%. That's the PVR. Then number 2 requirement, you have to calculate break-even points. Okay, which kind of break-even points is this one? Is it break-even points in naira or in units? Again, in the question we are not given selling price per unit. We are not given selling price. So it has to be break-even points in naira. So in this case, number 2, I would then say break-even points in naira equal to, of course, fixed cost divided by PVR. There's no need for you to say contribution margin ratio, since the examiner has asked you to calculate PVR in the first requirement. So that means they want you to use PVR instead of CMR. So don't go and do FC divided by CMR. So since you already have PVR, in this case, I would then say how much is fixed cost? Fixed cost is 100,000. When you add up these 3 numbers, that will produce 100,000. Therefore, 100,000 divided by the PVR is 0.2. When you do that, that will give us 500,000 naira. So that is how to calculate break-even points in naira for Jopagogo. Then number B, you are told that a proposal has been made to increase fixed cost by 10,000 naira. If sales and variable costs remain unchanged, compute the new break-even points. So fixed cost has changed. Therefore, B1, break-even points in naira, if fixed cost increased by 10,000 naira. So in this case, I would then say fixed cost. The original fixed cost is 100,000 naira. So it has increased by 10,000 naira. Then divided by PVR of 0.2. Therefore, 110,000 divided by 0.20. What do you have?
550,000.
That's 550,000. That answers that. Then the next one, number B2. Hope I'm not too fast. Number B2. The company is also considering another proposal to modernize its existing plants. This will need additional fixed cost of 25,000 naira with the expectation of saving the same amount in each of the direct materials and direct labor costs. If this proposal is undertaken, compute the profit of the company, the profit volume ratio, and the break-even point. Now, this is what the examiner is trying to say. that fixed cost will increase by 25,000 naira. That will take it to 125,000. However, it is expected that they are going to save the same 25,000 on direct material. According to this question, direct material cost is 300,000. Therefore, 300,000 minus 25 will give us 275. We're also going to save 25,000 naira from direct labor cost. Therefore, 300,000 minus 25, that's 275. That's what you are going to do. Sorry about that. So in this case, the first thing you are going to do is to prepare the profits. You need to prepare a revised profits in the revised income statement that will show the profit. All right, based on the change. So to do this, let me just look for, okay, to do this. Now, originally the sales value remained as 1 million naira. We are told that the company will save 25,000 naira from direct material. Therefore, 300,000 minus 25, that will give us 275. Direct labor, 300,000, we are saving 25,000. The same thing as 275. So factory overhead still remain as 80,000. Okay, variable factory overhead is 80,000. Marketing expenses is 80,000. Administrative variable admin expenses is also 50,000. So when you add up all the variable costs together, all right, you are going to have 750,000. So 1 million naira minus 750 will give us 250,000. That is the contribution margin, total contribution margin. Then you now less the fixed cost. Under the fixed cost, originally we have fixed overhead of 50,000. We also have marketing expenses of 30,000. We have administrative expenses of 20,000, make up 100,000 naira that we have. You are now told that with this new proposal, additional fixed cost of 25,000 will be incurred. So that takes our total fixed cost to be 125,000. Therefore, 250,000 minus 125,000 will give us revised profits of 125,000. Now that you have the revised 25,000, you need to recompute. You need to recompute the revised profit volume ratio. Therefore, to get the revised profit volume ratio, you are going to pick the contribution of 250,000. All right, you divide it with the sales value of 1 million naira. All right, that's what gave us the 0.25. That is the revised profit volume ratio. Then the next thing we are going to do is to calculate the break-even point in naira. Since our contribution margin ratio, our profit volume ratio has changed, then our break-even point will also change. So the revised fixed cost is 125,000 because break-even point in naira is fixed cost divided by contribution margin ratio. Therefore, 125,000. How do you get the 125,000? That is the fixed cost of 125 there. Then divided by the revised profit volume ratio of 0.25. That produces 500,000 naira. So that answers requirement number B. That answers requirement number B. Then for requirement number C, examiner is asking you that management accounting has an important role to play in decision making. Discuss these statements, explaining the concept which may be relevant and enumerate types of decisions to which they may be applied. We have done this severally in our previous classes, in some of our previous classes. When we had operating statements, I mentioned it. When we had relevant costing, I mentioned it. We also demonstrated with example past question. When we got to short-term decisions, I also mentioned it. Therefore, I want to ask you, how do we answer this requirement number C? If you know it, raise your hand. Requirement number C, how do we answer it? Yes. Who will take the lead? How do you answer the requirement number C? Jacinta, Janet, Judith, three of you, one of you should volunteer. How do you answer requirement number C? Jacinta, Janet, Judith, JJ. How do you answer requirement number C? So you muted now because I asked question, you're now muted. Isn't it? No worries. Yes, Oliver. How will you respond to that requirement number C? Oliver.
Well, let me just try.
Okay.
I think to answer this, we have to touch on the part of the what's it called? The marginal cost and the relevance of marginal cost in here. We also have to talk about the contribution on this and the importance that contribution plays, not necessarily a fixed asset for the contribution. That's what I think. That these two things are used to develop my points.
So how do you then just give us a hint? Give us a hint.
Okay. Yeah, the role of a marginal accounting cannot be overemphasized here because part of its function is the cost to make sure that the costing of product are done very well. And in order to do that also, since he's quite equipped with costing skills, he's in a better position to use the best costing practice, which in this case is the marginal costing over the assumption costing. And in doing that also, he has to explain the relevance of my marginal costing and why he has to use the variable cost, the role the variable cost plays in this.
All right. Thank you, Oliver. You have an idea of how to answer the requirement. The reason why I asked this is that yesterday I had a class in VI, and today also I have a class in I had a class in Solo on this same thing, and I asked them. None of the students got it correctly, and I was very annoyed with them because of the fact that we have discussed this severally, and I was surprised that none of them could give me the right answer. That means they have not started reading, which is not good. If you have exam that is about 2 months and few days, and then something you have done previously and we have tested severally, and then you can't produce perfect answer is unacceptable. Yes, you are right, Oliver. You are right. What examiner is asking you here, you recall that now you can see Jacinta is now coming up. When I was asking question, you muted. For like 2 minutes, you could not give me the answer. You muted as if I wasn't calling you. No problem. Yes. So to answer this question, what you are supposed to remember, you will recall that when we had operating statement, I mentioned to you that marginal costing technique is a concept designed principally to aid managerial decision. So anything that has to do with decision making, one thing should call your attention. It should cross your mind that, okay, this has to do with marginal costing technique. Oh, this pen has gone off again. Oh. Okay, let me just explain. Now, because it has to do with decision making, that means you need the concept of marginal costing. So what you are supposed to do here is to explain the marginal costing technique, and then examiner is also asking you to explain the concepts as well as to enumerate types of decision to which they may be applied. How do you apply marginal costing technique to decision making? You will recall all those things I mentioned under short-term decisions: make or buy decision, deleting of a segment, special order, shutdown of capacity, pricing decision, adding of a new segment, CVP analysis, optimal product mix, linear programming, all those I listed about 8 or 9 of them where you can apply marginal costing concept. That's the same thing that examiner is asking you in this particular requirement number C. So let's check out the way I answer it. All right. Management accounting plays an important role in decision-making to provide management with relevant and useful information suitable for making specific managerial decisions. The concepts which may be relevant to the role of management accounting include 1. Marginal costing concepts, 2. Relevant costing concepts. You now explain each of them. Marginal costing concept is described as a decision-making technique designed principally to analyze and compare the relevant costs and the associated benefit of a particular course of action to make managerial decisions. So all those stuff, just explain what marginal costing concept is all about. I don't want to repeat it. We have said it severally under short-term decision, under optimal product, under operating statement. So I don't want to repeat that. For this purpose, marginal costing technique is designed essentially to aid managerial decision in the following areas. 1. Cost volume profit analysis, deleting of a segment, make or buy decision, special order, shutdown of capacity, optimal product mix, linear programming, adding of a new segment, pricing decision. So these are the areas in which you can apply marginal costing technique to aid managerial decision. That is for that. In addition to that, you also talk about the concept of relevant costing principle. The principle of relevant costing can assist management in making appropriate decisions in relation to a course of action. Relevant costs are defined as costs that are directly attributable to a course of action in making managerial decisions. The management accountant will apply the relevant costing principle to a course of action that will have economic and financial consequence to the decision. Therefore, relevant cost is a future cash flow and incremental cost that arises from investment or business decision. So when you do this, of course, you are going to earn your full mark, and then the examiner will be very happy with you, with your response. So that answers that requirement number C. Now let's move to multi-product break-even. Let's see if I can spend additional 15 minutes before we close the class. All right. Once it is 6:50, we close the class. All right. Because I want to go and break my fast. Yes. We have tested 2 examples under single products break-even. So let's go to multi-products. Let's have question under multi-product break-even. So you can look for other examples in the material. Okay, go and try other examples in the material for your own consumption and for better understanding. You can also try as many examples as possible because you don't know where examiner will come out to you, and you have different scenarios. So just try as many questions as possible so that you can gain your confidence as far as CVP analysis is concerned. Then let's move to multi-products. So this is multi-product, but I'm not solving this. Let me look for the one I want to test. The one we are going to solve now. Now let's solve this illustration number 6. Number 6B. Babasue Nigeria PLC manufactures 4 products at its Abidjan plants. For the coming financial year, its budgeted sales and cost structure for the products are as follows. Okay, you have products A, B, C, and D. The budgeted fixed cost for the same period amount to 4 million naira. You are required to determine the number of units of each product to be sold for the company to 1, break even, and 2, earn a profit of 2 million naira. So you want to determine break-even points. What kind of break-even point? Of course, break-even points in unit, because examiner says you should determine the units, okay? You should determine the units of each product to be sold for the company to break even. You want to determine break-even point in unit to break even, okay? All right? So if that is the case, As you can see, this company has 4 different products. So in this case, you are going to follow the 5 procedures for calculating break-even points. So calculate break-even point for a multi-product organization. The first step you are going to carry out is to determine the overall contribution margin ratio. You calculate the overall contribution margin ratio. How do you do that? You are going to take the contribution of the entire organization. You are going to divide the contribution of the entire organization with the total sales value of the organization. When you look at the total sales given in this question is 18 million naira. So you are told that variable cost is 50% of total sales. So if variable cost is 50%, then contribution margin ratio is also 50%, because 50% of 80 million will give you 9 million. 9 million divided by 80 million is 50%. So there's no need for you to stress yourself on this. Contribution margin ratio is 50%. Why is it 50%? Because variable cost is 50%. Now you know that sales minus variable cost will give you contribution. All right. So since you have been given percentage of contribution, percentage of variable cost to be 50%, then it means that contribution margin ratio is also 50%. Okay. So let's see the way I answered that. So it's the same thing I just mentioned here. Overall contribution margin ratio, which is total contribution divided by total sales. All right. So which is 50%. No need to stress yourself. Step 2 says you should calculate overall break-even point in naira. You calculate overall break-even point in naira. How do you do this? To get the overall break-even point in naira, you are going to divide fixed cost of 4 million naira with the contribution margin ratio of 50%. That will give you 8 million naira. Let's see. Yes, fixed cost divided by contribution margin ratio. Fixed cost is 4 million naira. Contribution margin ratio is 50%. When you do that, that will give you 8 million naira. Then step 3. Step 3 says you should calculate sales mix. Calculate profit to sales ratio or sales mix. To get the sales mix, you are supposed to divide the sales value of each product with the total sales value. You are going, for example, you are going to pick the sales value of product A, which is 2250, divided by the total sales. Total sales is 18,000. Therefore, 2250 divided by 18,000, that will give you 12.5%. For product B, 4,050 divided by 18,000 will give you 22.5%. For product C, 5,400 divided by 18,000 will give you 30%. And then for product D, 6,300 divided by 18,000 will give you 35%. At the end of the day, all your calculation must be equal to 100%. Okay, so that is the sales mix. Then step 4. Step 4 says you should calculate break-even point in naira for each product. How do you determine break-even point in naira for each product? You are supposed to multiply the sales mix in step 3 with the total contribution, with the total break-even point in naira for the organization. All right, that will give you break-even point in naira for each product. Then step 5, you calculate break-even point in naira. How do you calculate in units? How do you calculate break-even point in units? Just divide break-even point in naira by the selling price. So you are going to match together step 4 and step 5 together in a table. You are going to match step 4 and step 5 in a table. And that is what you have here. First thing first, you are going to create a column for the product A, B, C, and D. Then you are going to indicate another column for sales mix. The sales mix you have computed in step 3. Put everything here. Then, of course, you now go ahead and put the contribution, the sales break-even point in sales of 8 million naira that you have here. So you come and put it here. That's the first thing you are going to write under the break-even point in naira. You are going to put the 8 million there. You then say sales mix of product A, which is 0.125 multiplied by 8 million will give you 1 million naira. 1 million divided by selling price of product A will give you 10,000 units. That's what you are going to do. Then the second one, let me see. This one will clean. It's not clean. Okay. Let me see. Oh. Okay. Let me know. Let me see if the pen is coming. Is back. No, still the same thing. It's hanging. No worries. I'll fix that later on. Now let's move on. So for product B, 6 mix of 0.225 multiplied by 8 million will give you 1.8 million. 1.8 divided by selling price of 450 will give you 4,000 units. You do the same thing for product C. Product C, 6 mix is 0.3. 0.3 multiplied by 8 million will give you 2.4 million. 2.4 million divided by selling price of 300 naira will give you 8,000 units. Then lastly, product D, 6 mix is 0.35. 0.35 multiplied by 8 million will give you 2.8 million. 2.8 divided by 200 naira will give you 14,000 units. So this is how to calculate break-even points in naira as well as in units for a multi-product organization. Then number B part of the question. Number B2. Number B2 of the question, you are to determine the number of units of each product to be sold for the company to earn a profit of 2 million naira. So in this case, the first thing you are going to do, your contribution margin ratio still remains the same as 0.5. But since you want to achieve a targeted profit of 2 million naira, so you need to first of all determine break-even point in naira to achieve a targeted profit of 2 million. Therefore, to do this, it will be fixed cost plus targeted profit divided by contribution margin ratio. So this will then be 4 million naira fixed cost plus targeted profit of 2 million naira, that's 6 million. 6 million divided by contribution margin ratio of 0.5, that will give us 2 million, 12 million naira. So it is that 12 million naira you are going to share using the 6 mix. Let's see how we treated that. Calculating break-even points in units of each product to earn a profit of 2 million. To do this, calculate break-even points in naira to achieve a targeted profit, okay? Calculate break-even points in naira for each product by multiplying the sales mix with the break-even point in naira for the company. Then 3, calculate break-even point in unit for each product by dividing the break-even point in naira of each product with their respective selling price. So this is just as we have done previously. So the first thing you are going to do is to calculate the break-even point in naira to earn a targeted profit of 2 million. So that is the 12 million naira that you have here. Then, of course, the next thing you are going to do is to distribute that 12 million naira you distribute it to each product using the sales mix. That is 1.25 multiplied by 12 million will give us 1,500,000. 1,500,000 divided by 100 will give us 15,000 units. I'm done with A. I'll move to B. 0.225 multiplied by 12 million naira will give us 2.7 million. 2.7 divided by 450 will give us 6,000 units. I'm done with B. I will also move to C. 0.3 multiplied by 12 million, that will give us 3.6. 3.6 divided by 300 will give us 12,000 units. I'm done with that. I will then move to D. 0.35 multiplied by 12 million will give us 4.2 million. 4.2 divided by 200 will give us 21,000 units. That is the end of the question. That's the end of the question. Okay. So, yes, we have 2 more illustrations under multi-product break-even. And then, like I said, once it is 6:50, we are going to call it a day so that we can, those of us that are fasting can go ahead and break our fast. All right. So this is where we are going to call it a day. So let me know if you have any question for me before we close the class. Talk to me. Any question for me? Okay. So in our next class, by the grace of God, we are going to solve illustration number 7 and the last question tested by ICAN on the break-even for multi-products. That would be illustration number, yes, this illustration number 8, Clinton. In your material, it is Abayomi, PSC. All right, so this is the question we are going to solve next time by the grace of God. All right, so in the absence of no further question, I want to say thank you for your patience and understanding. We meet again by the grace of God in our next class. Bye-bye, everyone.